Hello and good afternoon, everybody. Welcome to Forex 101 with me, OC Ejiofor. You are, well, we're not live, but we are in the honing block. I put together this series, just a little bit of background behind this now. So some of you may know, I'm a teacher by profession. I left education just over a year ago. And while I was a teacher, I kind of discovered my I guess, entrepreneurial drive while I was still a teacher. So I started a couple of things. While I was teaching, I started obviously tech tips and I started Edgeway Education. And that was because I was, in fact, the reality is it started off because I felt myself working myself to the bone. I just, every hour of every day was filled up with some kind of work. And I thought to myself, surely there must be a better way. There must be a way of being able to get paid more by putting in less effort, because I saw certain people, the lifestyle they're living, they're able to play golf, they're able to go on holiday, they're doing all of these things where it seemed like I was working every waking hour of my day. And I won't go into any more than that, but quite simply, that led me to a part of personal development. It led me to just learn about entrepreneurship even more. And I started those two ventures, as I said. And along the way, I've learned about foreign exchange. Now, I guess the small print is, I'm not an expert when it comes to foreign exchange, but those of you who know me know that when I know something, even if it is a small amount, I like to share that information with others. So what I would say, based on that, please do your own due diligence. When you want to find out information, just don't take one source as the only source of information that you have. For those people that know me, they know that I do my own due diligence, and I actually do quite a bit of reading around what it is that I'm doing. And it's based on that reading, I'm bringing you information, but you can always verify this information by doing your own due diligence. So please, please, please do that. So let me put my phone on silent. So the idea of today is to get into the basics of Forex. Have you seen a YouTube video of a man or a woman standing or sitting in front of a Lamborghini, or at the beach, or in the garage, and they've got all of these cars in the background, and they're advertising, they're saying, hey, look, I've made all of this money from Forex, and if you follow me, you can live a life of your dreams. Have you seen adverts like that? Okay, well, I have. And when you watch those adverts, you think to yourself, what kind of scam is this? And you skip. As soon as the 3 seconds are up, you skip. The reality is, I think those adverts, and everybody, they have their own hustle. That's great for those people that do that. And as long as they're given the right information, that is great. Well done to them. But to me, quite often we don't see trading or Forex trading as an actual profession, and it is really a profession. And I really want to stress that, because this is not a get rich quick scheme. And this is what I don't like about some of those videos that are out there. They actually make it seem as if all you need to do is, this and that, and then all of a sudden you are rich. There are people that make lots of money in Forex, and we'll get into how much money is exchanged in Forex in a moment. But there are a lot of people that lose money in Forex as well. So I'm sure you know people, and you've heard both. But those people who treat it like the profession that it is, they learn the skill, they take their time, they're patient, they have the right mindset and mentality, they do well 10 times out of 10. Because really is, I'd say, 10% the charts, 90% who you are and how you are with the charts, and what you know when you come to the charts. So welcome to Forex 101. So I am going to just click through the slides. Oh, it's not even in present. Let's just go to the next slide then. From here. There we go. Let's get into present mode. I wasn't in present mode. Tried to click across. Okay, so let's click across. So today, what is Forex and who's involved? Ignore the time frame. It's just being recorded now. So what is Forex and who's involved? We'll get into the charts and look at how money is actually made. And I really do want to take this as slowly as possible, so that the grassroots beginner, somebody who has no knowledge of it, will be able to grasp some of these concepts that can to be quite honest, look very daunting. When you look from the outside and you see someone's screen, you see they've got like 10 screens in front of them, right? You watch movies. If you watch movies, people know me, know that I watch movies. You'll see them sitting at their desk and they're kind of pressing a stress ball or something. They've got all these charts out and there's loads of different colors, loads of lines everywhere. I want to simplify things and make it as simple as possible. So we'll have a look at the charts and have a look at simply how money is made. We'll have a look at what's called currency pairs. And I'll explain that in a moment. Unfortunately, we're not able to do the live Q&A because we're not live. That is unfortunate, but yeah, let's get into it. So what is Forex and who is involved? So Forex is short for foreign exchange, and foreign exchange, when it comes to trading, is quite simply the buying, selling, and exchanging of currency. So what does that mean? That means every time you go to the Foreign Exchange Bureau or the Bureau de Change, you go to give your local currency. So if you're in the United Kingdom, you will hand over your pounds and you will hope to exchange it. Well, you should exchange that for the local currency of the country that you're going to visit. Naturally, during this time, nobody's going anywhere. But we can do, I've got some VR goggles. I'm going to try and go on holiday a bit later. But you would hand over your local currency and you exchange it. So if you were going to America, you'd hand over your pounds and you would exchange that for dollars. And when you receive your dollars, you receive a certain amount. Now, the amount that you receive is all 100% dependent on this market. The exchanging, the buying and the selling of each currency determines the value of that currency at that particular moment. And which is why sometimes you will exchange your money and you'll get a certain amount of the local currency when you're going there. And it just seems to happen that while you're on a holiday, when you exchange your money back, you lose even more money because the rate has changed during the time that you were on holiday. Sometimes, every now and again, it may work in your favor. But this is the exchanging of currencies. You hand over your money, you're taking part in the Forex markets. So, who is involved? Well, I've put down here the banks, institutions, retail traders, and people who change their money. So I've explained the last one, which is people who are exchanging their money to go on holiday, etc. So what do the banks have to do with it? What do the institutions have to do with it? And what on earth is a retail trader? Well, I shall explain. Naturally, here in the UK, we have the major bank that controls the whole monetary system of this country. If we need money printed, if we want to know about our exchange rates, etc., the rates of interest in this country is controlled by which bank? Somebody tell me. I wish it was live. It's not live. Yes, that's right. Well done, you. It is the Bank of England, and every single country has their own central bank. Those banks speculate on the value of currencies. And when we talk about, when I use the word speculate, that means to take a position on the value of that said currency. So if you are to speculate on the markets, you are taking a position that is to say, I am speculating that the price of this currency is going to go up, and contrasting the value of the other currency that is paired against is going to go down. And therefore you take a buy position in the market and in the hope that the value of the currency will go up. And we'll get into that a little bit more later. In the old days, it was only investment banks that would speculate on the markets, and the other banks, the high street banks, they wouldn't get involved so much. However, they saw so much money was being made by these investment banks, they said, hey, let's all get involved. So obviously it's a domino effect. So when one does, everybody does. And what you have now is your average retail bank like HSBC, Barclays, Lloyds, every single one of these banks that will have a trading arm of just a floor of traders who are taking positions on the markets. And therefore, they control the majority of the money in the markets. Everybody puts their money in a bank. And because of that, they can command millions and millions and billions of money, amounts of money in the form of contracts when they go into exchange to the foreign exchange markets. So the banks are the major players. Next, we have what we refer to as institutions. Now, these institutions, you may know, they're referred to as hedge funds. They're not quite banks, but what they do is they will, in simple terms, hold rich people's money. So rich people will say, hey, look, I have £1 billion. I'm going to give it to you, Mr. Hedge Fund Manager, and I want you to increase my money. So they know that when the hedge fund takes their money, they are going to also speculate on the markets, and they are going to take positions, buy positions, or sell positions in the hope that the value goes either up or down within the market, thus making more money on top of what they've been given. So they don't have as much money as the banks, but they have considerably more money than the average person would have. Interesting fact, during the 2008 crash, the scandal with all the banks, etc., it's funny that not a single executive of any of the banks were arrested because of what happened during that. And look it up and find out for yourself. But it was one of the top hedge fund managers that actually did some jail time. I think there was him and one banker. Not even a manager, one banker that actually did some jail time. But apart from those two people, I don't think any single person was arrested. And when you really look into it, you know that there was some, there were legal implications around what happened during that time. And it's very unfortunate because a lot of people lost their jobs, etc. And some people even, unfortunately, lost their lives. But it was only a hedge fund manager. And that is what we would refer to as an institution. So they are the two major players. The banks are number one, and number two are the institutions. Next, you have retail traders, and retail traders are people like myself and some of my colleagues. I've interviewed some retail traders in the holding block. People like Des Ame, for example, people like Bryony Bender, people like David, oh my goodness, David Talbot, my goodness, every single David that I knew just now just came flooding into my head with their surnames. But now David Talbot and Richard, oh my goodness me, this is really bad. Sorry, Richard. Yeah, Doherty, that's it. I don't know where my brain is right now. But anyway, let's crack on. So retail traders, people that the average person who is only coming in either with their money, usually with their own money into the markets, and they're trading with smaller amounts. Now, all of that will make a lot more sense when we actually take a look at the charts. This is some background into, first of all, what the foreign exchange markets are. So they are a means in which people are buying, selling, and exchanging currency. The main players who's involved are the banks, institutions, retail traders, and people who change their money to go on holiday. It is the largest financial market in the whole entire world. It is bigger than all the other markets put together. So that means it's bigger than the stock market. It's bigger than all the other markets in which people would make investments, in which people would trade. And yes, that is a capital T after the 6.6. So that means it is $6.6 trillion in that market. It is a $6.6 trillion market. That is huge. So when you put the value of all the other markets together, they still do not come close to the amount of money that is exchanged in the Forex market. And that being said, every time money is exchanged, someone is making money, somebody else, unfortunately, is losing money. It just depends on the position that they take. There's an interesting fact. I've typed it up on my phone. I do a lot of note-taking and study. And I found an interesting fact on my phone. There we go. Apparently, every 6 seconds, let's wait, 2, 3, 4, 5, 6. There we go. Okay, so $300 million just changed hands in the foreign exchange market. Right? Every 6 seconds, $360 million changes hands in the foreign exchange market. So that's just a fun fact for you. Okay, so We do have another slide, do we? Oh, no, we don't, do we? I think we're just going straight into the charts now. Is that the plan? Yes, it is. That was the last slide. So the charts, how is money made? So let's open up a new tab here. And let's go to a website called TradingView. And what I'm going to do is open up a chart and do my best to explain the basics of how the charts work and actually how people make money. And then we'll just have to close it out because we don't obviously have a question and answer session. However, if you do have questions related to this video, please pop them underneath the video and I will do my best to answer those next week. Okay, so what we're looking at here is a foreign exchange currency chart. Now, as far as charts work, excuse me, as far as charts work, you know that we have the X and the Y axis, and X is the horizontal axis going across, and going across, we simply have time. So time is the value of the X axis going across. And then what we have on the Y axis is we have the actual monetary value of that currency expressed according to the pairs that we have displayed. So right now we are looking at the Great British Pound against the Japanese yen and the value of those currencies. Please excuse the pop-ups that may show up on the screen. That is because I am not using a paid version of TradingView. TradingView is free and you can use it for free. People use it to analyze the charts. And we can talk about analysis and the types of analysis in the following lessons, the following weeks. But quite simply, yes, as we said, so time is going this way. I'm actually going to close that section there just so that it's nice and simple for you. So we have time going across the bottom, across the x-axis, and we have the value of the currency on the y-axis. And what it is showing us is that as time goes on, the value increases or decreases. So on this chart, we have two, I'll call them blocks. We have a green block and we have a red block. The blocks in this form are referred to as candlesticks. There are other ways of looking at the charts. You can look at the charts in different types of candlesticks. You can look at them as lines and you can look at them as dots. It shows you the same thing. The majority of people that look and take positions and speculate on foreign exchange markets do tend to look at them in candlestick form. It's actually the most popular view of looking at and analyzing the charts. So when you see these candlesticks, what they're showing you is the movement of price during a particular time frame. So what I have is I have this chart set up. You can see 1H here at the top. And as I hover over it, you can see that it's saying 1 hour. So that means that for each of these candlesticks, it shows the movement for 1 hour. After the hour changes, and this is according to the time on our clocks, a new candle is formed. So right now, if we go to where price is currently, that's what this green line represents where price is currently. And as we watch the chart, you'll see this will move down or it will move up. So during this hour candle began at 4 o'clock. Sorry, at 3 o'clock, 3 p.m. this afternoon. And we can see, if you can see where my mouse is, at the bottom, at the very bottom, you can see this gray box that appears. And you can see that as I'm over this candlestick, you can see it says the 23rd of April, 2020, and that's the 3 o'clock candle. If I move to the previous candle, that's the 2 o'clock candle, 1 o'clock candle, so on and so forth. And if you are looking at TradingView and it's showing a different time, you need to check at the bottom here. And what we see here is UTC +1, which is our British summer time, because we've moved our clocks forward, and that's showing the correct time for the zone that I'm in now. If you're watching this and you're from another country, you might want to adjust that accordingly. So what we have here is the time from 3 o'clock. I know, because I have that understanding, that when 3 o'clock came, the price started at this level here, which is, I can see on the gray on the right hand side, 133.067 Japanese yen per £1. That's what that value means. So at that point in time, the yen was at that value. As the hour has gone on, we can see there's a little green line underneath there. That little green line shows me that price went down to as low as this point. But since then, it's actually gone up. And when it goes past the entrance where it's entered, it actually creates what's called a body of the candle, which is the thicker section. And now what we can see is price has gone all the way up to this point here, which is 133.668. And now you can see in real time that price has dropped below there. So it hasn't gone past that top point. It's come down a little bit and it is hovering around this area here. And we can see price going down, going up as we're talking. But that is how a candle is formed. So if you have that understanding, you'll be able to understand that each hour a new candle is made. If price goes up from where it starts, it will be green, which shows that price has increased in price. When price started a new candle here, when the time changed, the price was at this point. It only formed a wick because it went back up. If price continued to go down, we would have a red candle because price has continued to go down. An example of that is here. At 7 o'clock in the morning today, price stopped here. It closed out the hour. It started up here at 7. It went up a bit, it went down a bit, and then it closed at this level here, and it opened up a new candle, and it went straight down. It didn't really form a wick at the top. You can see that particular candle has no wick at the top, and I'll zoom in just so you can see that a bit clearer. There is no wick at the top. So when price started here at 8 a.m., it went straight down and it continued to go down. It may have gone up a little bit during the hour, it may have gone up, but it continued to go down. The lowest point is at the bottom of the wick there, and then it closed the hour here. When it started a new hour at 9 o'clock, it went down a little bit and then it went up all the way up to here and then closed the hour here. Next candle went up, it went down, all the way down to there, closed there, new candle, went up, went down all the way to there, closed there, and so on and so forth. You can see this is how the patterns are formed on the charts. And that's something for you to really get comfortable with and understand, because that is really the basics of how the patterns are formed. So that's great, OC. We know that time is moving across and price moves up and down. Why is price moving up and down? Well, it goes back to what I said before. People that take positions on the market will put their money into the market to speculate on the price of the actual currency. So in this case, people would take a buy position or a sell position on the pound versus the yen pair. If they were to enter this trade at this point, they could speculate and say that price will continue to go up, and they could place a buy order on this pair. And what that would mean is if they've placed a buy order, wherever price is, as soon as they click the execution of that trade, as soon as that order has been executed, they would have an entry line. So wherever price is when they press enter, that is their entry line. And the hope of the trader is that as time goes on, their order is to place a buy position. They would hope that where the entry line is, and I've left my mouse there just to show you, that price would continue to go up from that point. And how money is made is that as price moves, you can see it's moving little bit at a time. Each time it's kind of in a ticking motion, moving up or it's moving down. What those movements are referred to in trading is they are called pip movements. And what pip means is price in percentage. And I will explain in following videos exactly how much you would get paid per movement. But for now, just know that for each movement that happens, somebody actually gets paid. Now, how much, yeah, as I said, that how much they get paid will depend on the distance between where they've entered and where they want their profit to be taken. So it could be that they've entered the trade here and they want to take their profit somewhere up here because they're aiming that it will continue to move until it gets up here. And they would have something in their trade called a take profit price. So that means when price gets to that point, their trade is closed and the profit is realized. So they enter the trade at a specific point, and they're speculating that price would get to a specific point, and they are saying to the charts, actually, at this point, take me out of the trade. I want to take my money at that specific point because I'm happy with that amount of profit. Where money is lost is if they put in a buy order and actually price doesn't go in the direction that they wanted it to. So if they've wanted it to go higher, as I've suggested in this case, and then all of a sudden it doesn't go higher, it goes lower, and actually the next candle is a red candle and it starts to go down, then naturally someone can lose money. And a sensible trader will put in a good risk to reward. So that means they are calculating their risk, and they do that by putting in something called a stop loss. And when they put in that stop loss, is a specific line on the charts that said, if price goes in the opposite direction, I'm only willing to risk losing this amount of money. And in the following weeks, I will go into actually placing a trade, setting a stop loss, and setting a take profit. And we'll also have a look at analysis. But for now, that has been the first session of Forex 101. What is the foreign exchange market? Who takes place in the foreign exchange market? What are the charts? How does it work? And what we'll do is in the following weeks, we're going to have a look at the different currency pairs, because we have the pound Japanese yen. We also have the pound US dollar, which some people may be more familiar with. We also have the euro and the Great British Pound as well as pairs. And you can see each of these, the charts look slightly different. And as the weeks go on, I'm going to introduce you to some of the tools here. We're going to do some analysis and have a look at how people can analyze the charts, because really taking a position in trading is all about confidence. It's not about going into a trade and just guessing whether the price is going to go up or down. There are a number of indicators and tools that can be used to increase the confidence of a trader when they go into the markets. The amount of knowledge that you know in terms of the different indicators, the different things that affect the markets, and the different tools that you can use, all of that knowledge are limiting factors in the success of traders. Hence why some people really do make money consistently and other people do not. If people go in thinking that they know exactly what they're doing, and actually they don't really have knowledge of some other things that could help them to be a lot more sure of both when to go into the market and also when to come out of the market, unfortunately, that is where people tend to lose money. So it really is about getting a good education. I joined an online trading academy, and that is where I've got 100% of my knowledge of trading. It's how I met Desame and all the other wonderful retail traders that I know. So that has been the first session of Forex 101. I am going to go live next week. Hopefully I'm going to go live next week, and we'll get into some more information. Please, please, please give me some feedback. How has this session been? I want to know, has it been too much information? Has it been not enough information? Has it been at the right pace? I don't want it to be too fast. I want it to be really simple so that people can actually assess how these things work, because I think you don't know if something is for you or if it's not for you until you know the basic information. So that is the idea here, for people to get to know what the markets are about. So thank you so much for watching Forex 101 with OC Ejiofor. I would please join me next week for more live interviews and another Forex 101 session. Thank you so much. Take care. Have a blessed day.